It is often said that there is too much dysfunctional short-term behaviour in markets, coupled with calls for more long-term investing. If investing for the long run is so desirable, why is there not more of it? And what does it take to be a long-term investor? In 2014, CIFR collaborated with the Future Fund to investigate long-term investing from the perspective of institutional investors. The research resulted in 3 papers examining the nature of long-term investing, its benefits and pitfalls, and how an investment organisation might be designed to invest for the long run. Today I will outline the 2 key characteristics of a long-term investor, and I will then discuss how organisations might be structured to successfully invest for the long run. The first characteristic of a long-term investor is high discretion over when they trade. It is this discretion that provides both the latitude and the confidence to pursue investments that may take some time to pay off. One way in which discretion over trading can be lost is through being forced to trade due to loss of funding. Another is being placed under pressure to respond to short-term performance. Many fund managers face exactly these type of pressures. Indeed, the industry-wide tendency is to focus on and react to short-term performance. This is one of the key barriers to long-term investing. The second key characteristic of a long-term investor is having an investment approach that is focused on long-term outcomes. Long-term investors don't trade, they invest. Long-term approaches tend to direct attention towards long-term cash flows and potential long-term returns. By contrast, short-term investors are primarily concerned with the next price fluctuation. In order for an investment organisation to successfully invest for the long term, a good start would be to bolster discretion over trading wherever possible and embrace an investment approach that looks through the short-term noise. However, addressing these 2 characteristics is by itself not sufficient. Attention also needs to be paid to the design of the organisation and its incentive structures. The aim is to establish an environment where all concerned think and act in terms of long-term outcomes and are rewarded primarily for progressing towards long-term goals. This is far from easy to achieve, given the structure of the industry. Investment organisations often comprise long chains where the management of money is being delegated down from one level to the next, from end investors to the board to internal management and hence down to external managers. The problem is building alignment with the concept of investing for the long run right along this chain of delegations. To build alignment, a range of aspects need to be orientated towards the long term. These include the organisational principles and investment objectives, the organisation's culture, its people and the managers that it employs to do the job, how outcomes are framed and then evaluated, and finally, how success is rewarded. The third paper in CIFR's long-term investing series develops these ideas in some detail. Nevertheless, it is worth highlighting that one particular challenge, how to deflect attention from the flow of short-term results, is central. If investment managers are incentivised to deliver short-term performance, because that is what everybody is fixated on, then short-term performance is what they will aim for. A key strategy is engagement and communication. If those evaluating a manager understand the reasons for a long-term investment and its subsequent performance, they will become less likely to rely on shorter-term performance numbers in making their judgment. Another strategy is to base incentives around the contribution made in working towards long-term objectives. Including a subjective component in the bonus determination can help here. This provides a mechanism for explicitly rewarding long-term focused behaviour. Another idea is to pay ongoing awards, which is in accordance with industry convention. However, only allow these awards to vest and be paid if performance is subsequently sustained for the long term. This too will help ensure that the manager maintains their sights on securing the long term, rather than chasing short-term results regardless of their sustainability. Long-term investing can be desirable, but tends to be hampered by how investment management organisations are structured. Hence, organisational design is a prime area for attention if investing for the long run is to become more prevalent.